Hello, good morning. Welcome to this monthly debt outlook from Canara Robeco. I am Avnish Jain. Let me start by talking about global macro landscape. Globally, growth continues to remain resilient, especially in countries like US, and inflation continues to moderate. US growth again beat estimates in the third quarter, and labor market continues to remain strong. In this scenario, the US Fed has paused any rate hikes but are still to make a decision on rate easing. While it has been indicated by the US Chair Powell that rates will be eased, the question remains of timing. Earlier market expectation was that the first rate cut may happen in March of 24. In the latest policy, however, the US Fed pushed against that and said they needed more time to see inflation go down sustainably to 2% level before they start easing rates. It is therefore expected that rate easing may start May or June of 24. US rates, which had rallied in December on back of US Fed pivot, with the 10-year going down to 3.8% in December, reversed some of the gains and the yields climbed to 4.10 at present. Going forward, the rate easing cycle will be determined by incoming data as the US growth remains resilient on back of a robust labor market and signs of moderation in labor market are still to be felt. Coming to India, the Indian markets continue to show resilience. If we look at macroeconomic data, it continues to be strong, especially on growth. Growth numbers have beaten estimates in the past two readings in last two quarters. RBI has also raised projections for growth of FY25 to 7% from a last number of 6.5%. Clearly, Indian economy continues to go from strength to strength. Inflation has moderated, though at a slower pace, and that has put RBI on the pause mode. Two major events have happened in the near term. One was the interim budget on 1st February, in which the government surprisingly showed a fiscal deficit of 5.8% for FY24, the current fiscal, and has projected a much lower fiscal deficit of 5.1% for FY25. Clearly, the government is serious about following the FRBM glide path and are projecting to reduce fiscal deficit to 4.5% by FY26. Overall, the gross borrowing numbers will drop from 15.4 lakh crores to 14.1 lakh crores, a clear positive for the markets. Overall, we are seeing fiscal consolidation happening, especially on back of very robust tax revenues, as well as quality of expenditure, where we have seen large amount of expenditure. Approximately this year projected is 23.3% of expenditure will go towards capital and infrastructure investments. The latest policy from RBI, which happened on 8th of February, RBI chose to remain in pause mode despite government fiscal consolidation, which could have provided room to RBI to go little easy on the monetary policy. Considering that growth has been strong, RBI has the luxury of focusing on inflation to bring it down to 4% level over medium to long term. Lower inflation is a bedrock of strong economic growth over long term, and considering RBI has the room to remain higher for some more time as growth remains strong, they can choose to delay any rate easing as far as possible. RBI has projected 7% GDP growth for FY25 and a much lower inflation of 4.5% for FY25. We expect RBI to move on rates probably in the second half of FY25, especially after US Fed eases, which is expected to be in the May or June of 24. RBI is likely to stick to smaller rate cuts as a large rate cut is not required, considering that growth is projected to remain around 6.5 to 7% in the coming years. Easing will be more driven by global factors like the easing by US Federal Reserve. Now coming to what investors should do, clearly going forward, we have these following points. One, the induction of government bonds in the JP Morgan Emerging Market Global Bond Index has been a big positive for bond markets. In 2023, we saw inflows of almost $8.4 billion coming in debt markets from FPIs or the foreign portfolio investors. This year, already from January, we have seen $3.5 billion of inflows in debt, 1.1 billion coming on February itself. Clearly, the flows have started ahead of index inclusion, which is likely to happen in June of 24. The inflow of around 20 to 25 billion is expected in the next 1 year, and that should keep yields lower. That would be the main factor driving markets. On top of that, you will probably have a rate easing cycle starting somewhere in August in India, while global rate easing may start in the first quarter of FY25. Like we discussed, RBI is likely to wait a little bit more to get more handle on inflation and see inflation go down on a more sustainable basis before they ease on rates. We feel that next year yields are likely to go down because of the above two discussed factors. One, because of inclusion in the JP Morgan bond index, which will see large inflows coming from FPIs on a passive basis. Second, the rate easing cycle will start, is likely to start in next few months. Rate easing cycle is likely to start in the next few months, and RBI may follow in the latter part of the year. For investors, we feel that it is right time to start adding duration to their debt allocations, and they can do it through medium duration funds like banking and PSU debt funds, or longer duration funds like gilt funds. Overall, as always, investors should invest according to their risk and return profile and probably benefit from the expected easing of rate cycle in the coming year. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.